Okay, well, thank you for having me today, and I appreciate everyone spending a little bit of your time with me today. I'm going to talk about what we refer to at Options Moneymaker as the art of trading, because I truly believe that trading options is an art form, and it's something that you become very familiar with, you become passionate about, and your primary success is going to be driven by your attention to that passion as well as your discipline. So what I want to talk with you about today is how to simplify your trading and grow bigger profits. Oftentimes we as options traders complicate our trading to a point where we really are interfering with our ability to grow our profits. And I'm going to show you a method that has proven very, very successful with hundreds of our traders in our community and ourselves, myself and my trading team. And it's a great place for new traders to start if you're just brand new to options trading. It's also a great place for experienced traders if they're looking for a way to simplify and grow bigger profits. So let's just go ahead and get started. Now, the key success factors to winning consistently are, hang on one second, I'm going to just, I skipped one slide here. Just real quick, in 60 seconds, I've spent over 30 years trading. I spent 20 years as a senior executive with a Fortune 500 company, and during that time I traded as a hobby because I just really was quite taken with it. I've traded commodities, I've traded futures, I've traded stocks, I've traded options, and in the last 10 years or so, as I've been teaching, I settled on options trading. I founded Options Moneymaker in 2009 because I had more and more people asking me from my circle of friends and associates and acquaintances that were asking me how it was that I was able to do what I was doing in the options market. And I wanted to formalize that a company so that I could help other people learn the art of trading. We're very active traders, myself and my team of three traders. We are active in the markets every day. We're actively trading. We're actively coaching our clients in our trading community. We host 2 live trading rooms every day. One is for more casual traders, part-time traders, newer traders, and one is for full-time traders who want to day trade, have full-time attention to focus to the market. We teach new and experienced traders, both active and casual traders, and we work very hard to help our traders learn how to win on a consistent basis. So there are a few very basic key success factors to winning consistently if you want to trade options successfully. Far too many options traders come to the market every day without a plan, without really knowing what they're going to do that day. They know that they should look for opportunities to get into positions. They know they should try to hold on to a position and let their profits run. They know that they should cut their losses. But other than those very commonly understood phrases and mantras that are common in options trading, they don't really understand what to do. So what we do at Options Moneymaker is we break it down for you and give you the key success factors, the things that are going to allow you to win and make money. So first of all, we keep things very simple. There's a lot of complexity in options trading and a lot of complexity in reading charts that doesn't need to be part of your trading. It can eventually be part of your trading if you decide that you want to learn more, but you ought to at least start out by making money with being comfortable with what you're doing. So you want to trade a strategy that you're comfortable with. Don't do the flavor of the month club where you're trying a different strategy every month. You're not really going to learn how to trade successfully doing that. And use a strategy that has variations that can flex to any market move. A lot of the questions I get about the strategies that we teach at Options Moneymaker are all about how does this position or how does this strategy hold up in a strong market move to the upside or a strong market move to the downside or flat volatility. And what you really want to do, in my opinion, is adapt a strategy to your trading that is going to be able to flex to any market move and any market condition. And first and foremost, you want to learn, you want to trade to learn first. Trade to learn first. Learn so that you understand what you're doing, and then trade to earn grow your profits. Second, if you invest some time and some discipline in trading to learn first, which means maybe you don't make a lot of money, but you understand the dynamics of a position, you understand how it reacts to different market conditions, then you can move full speed ahead with trading to earn. Unfortunately, my experience in teaching thousands of traders over the last many years is that most traders come to the market with an appetite for earning without really having learned what they're doing. And there aren't very many professions out there, key professions that require a specific skill set that you would take that approach. People go through years of college to learn how to be a professional in many different professions before they set out to earn. People will learn how to fly an airplane well before they would ever think about becoming a commercial airline pilot and earning money. In options trading, if you devote the same philosophy to learning first and earning second, you can vastly improve your chances of being a successful trader. And always, before you trade, know the capital you are willing to risk, the amount of money you are willing to risk in any particular trade and in general. Don't ever exceed your allowed risk capital, no matter how great that opportunity is that you see or how much you feel compelled to take action. The entry signals that you use are ones that you should understand before you start trading. Know what type of an entry signal you're going to use, and I'm going to explain to you an entry signal that we keep as a very simple approach, especially for new traders and people who are interested in simplifying their trading. And then know before the market opens what strategies you're interested in using. Generally, keeping it simple to a single strategy is going to be more successful for you, and if you really become intimately familiar with a particular strategy, you're more likely to be successful. So if you know what you're willing to risk, and there's always risk in every trade, and you know that you'll never exceed that risk, then you can't get yourself into trouble. It really pains me when I hear options traders talk about how they got themselves in a pickle just because they have too many positions on, or they have too much risk on, and now they don't know what to do. That's not the time you should be figuring that out. The time you should be paying attention to your risk is before you ever enter the trade. So it's the risk, it's the signals that you're going to use to enter trade, and it's the strategy that you're going to use to take advantage of that signal. So what I'm going to focus on for today's presentation is credit spreads. And I focus on credit spreads because, first of all, they can be traded as a very simple, hold on just a second. They can be traded as a very simple directional strategy, but they can also be traded as a non-directional strategy. So that gives us a lot of flexibility as we adjust to whatever the market is doing. Credit spreads are also a great place for any brand new options traders to start. It's one of the most commonly understood spread strategies in options trading, and there are ways to open your credit spread positions and have what we refer to as a forgiveness factor, which I'll touch more on in just a few minutes. So if you can open a credit spread as a directional bias strategy when you see a declining or rising bias signal, and you also know that you can use a credit spread as the basis for opening a non-directional strategy, which is referred to as an iron condor, then I'm also going to share with you a unique approach to trading iron condors that we use here at Options Moneymaker for many of our clients in order to accelerate profits. So again, credit spreads, it's one of the most commonly traded strategies because it's simple, yet a lot of traders fail trading credit spreads, and it's really not necessary. After talking to hundreds of traders throughout live seminars that I've delivered and many webinars and traders that I coach, I've determined that the main reason traders will fail trading credit spreads is improper selection of the strikes. They don't really know where to place their position and how to choose their position properly, and I'm going to help you understand that today. You'll be able to go out and take action tomorrow if you choose to. They also don't build enough time into their position. They're jammed right up against expiration, so they've got no time if the market were to move against their position. And they have a very naive assessment of risk too much risk that they put in play, and that gets them into trouble. So those three things, if we can fix those three things, most anyone can learn how to trade credit spreads successfully. Now, the three steps that we use for trading simple credit spreads are step number one. We're going to use 2 and 3 standard deviation Bollinger Bands to decide when to open our positions and where to place our risk strikes. We typically use 30-minute time periods, 60-minute time periods, and daily charts. And if we place our strikes outside the Bollinger Bands, this creates what we refer to as a natural forgiveness factor. I'm going to give you a real example and highlight that natural forgiveness factor in just a minute. Step 2, expiration should be out from today 2 to 4 weeks. We want to build time into our position because time is always our friend. We want to take advantage of the time value decay that is inherent with options trading and specifically with credit spread trading, but we don't want to be only out a few days or even out just 1 week. We want to have enough time so that we can maintain control over our position. And step 3 is when we open a credit spread, we want the credit to be in the range of $1.20 to $1.80 on a 5-point spread. So 5-point difference between the two strikes in the spread. If we follow these guidelines, these simple guidelines, using 2 and 3 standard deviation Bollinger Bands out 2 to 4 weeks and looking for a credit of $1.20 to $1.80, these guidelines are also intended to flex according to low and high volatility conditions in the market. If you're in a higher volatility condition than we're in today, then $1.20 to $1.80 of credit on a position is going to be further out of the money, which builds a bigger forgiveness factor, and it's going to be further outside the Bollinger Bands typically. So the rules that we follow are designed specifically so that it can flex to most any market condition. Position size should also always be based on your personal risk tolerance and never overextend your risk. So let me first of all, if you're not familiar with them, show you what the Bollinger Bands look like on a simple chart. There are a lot of great, more complicated, more sophisticated, more technical charting tools out there, and some of them are really awesome. I've got some friends who have some great programs, and they're really very well done and easy to use, but you have to start to walk before you run, and that's true with options trading, especially charting, and you don't want to get bogged down in the complexities of a very advanced charting mechanism before you ever really learn how to trade. So just very simply, the Bollinger Bands are the blue lines on the chart. There is an outer set of bands on both the upper and lower side of the price activity, and these are the 3 standard deviation Bollinger Bands. And there is an inner set of lines that are the 2 standard deviation Bollinger Bands. Now, the reason we use Bollinger Bands with 2 and 3 standard deviations is because we know in our experience that the indexes in general, and what I'm showing you here is the S&P 500 index, the indexes in general and the market in general and most of the major stocks that most people like to trade will float back and forth between the upper and lower Bollinger Bands. Now, that doesn't mean that the minute it hits a lower Bollinger Band, it immediately moves all the way to the upper Bollinger Band. But it is a very general guideline to help us understand what the bias is, what the likelihood is of an index or stock moving in a particular direction. When you're at or near the lower Bollinger Bands, there's an increased probability of a movement towards the upper Bollinger Bands. And like I said, it doesn't necessarily happen immediately. Here we hit the lower Bollinger Band and continued moving lower for 2 or 3 days, and then boom, we moved significantly higher above that point that we might have gotten into on a rising bias trade. But if we place our strikes properly and build a forgiveness factor in, even a movement against our position, as long as we have time built into the position, isn't going to hurt us. So just very simply, I wanted you to see what a snapshot of a 2 and 3 standard deviation Bollinger Band pattern looks like and how the price activity on an index can move quite nicely back and forth between those Bollinger Bands. So let me give you an example of a credit spread. I just want to make sure we're all on the same page in terms of simple understanding of what a credit spread is. So here's an example of a credit spread on the S&P 500. Okay, these are trading options on the S&P 500. This is not SPY, which is an ETF that tracks the S&P 500. At Options Moneymaker, we like to trade index, options on indexes. That's S&P 500, the NASDAQ 100, and the Russell 2000. They're very easy for us to trade. They're easy to identify the cycles, and there are a lot of reasons that it simplifies our trading. I won't get into all those right now, but S&P was trading at 2183 during September week 1. So we identified on the chart that there was a declining bias, and that's because we look at the chart, we look at where it's trading relative to the Bollinger Bands, and a couple of other factors, and we decided to take advantage of the declining bias by selling to open a call credit spread. When you have a declining bias, you want to trade a call credit spread, and when you have a rising bias, you want to trade a put credit spread. Now, the opening of a credit spread is actually going to create a credit into our account. It's going to bring cash into our account. But there is risk on that credit spread. So here we are selling to open a September week 4, so 3 weeks out from expiration, or 3 weeks out to expiration, 2205 call. Now 2205 is out of the money. It's about 22 points above where the index is currently trading. So that is what we refer to as the forgiveness factor. It's a 22-point forgiveness factor because the index could actually move up 22 points and we could still have a profitable trade. All we care about is that the price of the index remains below the risk strike, the strike that we sell to open. The other side of our spread, because a spread always consists of 2 option legs, is we're going to buy to open the same expiration, week 4, SPX 2210. This is the next strike available on the options chain. Options chain is where you're going to identify all of the options that you could trade. So we have a 5-point spread between our risk strike and our long call. That means that we have 5 points of gross risk in the trade. Now we took $1.80 of credit when we opened this, so the 5 points of gross risk minus the $1.80 means that we have actually $3.20 of net risk in the trade. So if I was trading 100 shares, which is 1 contract, I'd have $320 of risk in the trade. Now my opportunity, my maximum opportunity for profit is $1.80. If I hold this position until expiration and the price of the index remains below 2205, the most I can make on this trade is $1.80. Now $1.80 of maximum possible reward compared to our maximum risk of $3.80 is a nice risk to reward ratio. I will tell you, we don't hold until expiration. We never do. And I'm going to show you how you can actually harvest profits out of a trade like this well before expiration and then close out of the whole position. But the 2 key things here I want to point out is we have a 22-point forgiveness factor based on the risk strike at 2205 and our price of the index at 2183. We have 3 weeks to expiration, so it fits right into our model of 2 to 4 weeks to expiration, and we want to build a forgiveness factor in. Now it's not always a fixed 22 points, so I'm going to show you a chart here in just a minute and show you how we chose that strike. So this trade is actually set up to benefit from a move down, but that forgiveness factor that I'm talking about says that we could still be profitable on this trade if in fact S&P moved up, but stays below 2205. So again, back to the Bollinger Bands. Here we are seeing our Bollinger Band pattern, and right in here when we opened the position, the index was trading around 2183. It was trading right at the upper Bollinger Band. That implies to us, but without any guarantee or certainty, but it implies to us that we could see the index reverse and start to move lower. So that's where we want to take advantage of a declining bias trade. But what we want to do is to give ourselves a forgiveness factor and some cushion in case the index moves higher before it moves lower. So one of the things that we know about Bollinger Bands is this. Not only do they move back and forth between the upper and the lower, but when the price moves outside the Bollinger Band, especially outside the 3 standard deviation Bollinger Band, it increases the likelihood that you're going to see a more substantial reversal. Or if it's not more substantial, it increases the likelihood you're going to see a reversal pretty quickly. There are some great examples in here where like back here where we moved above the 2 standard all the way up to the 3 standard, and there was an almost immediate reversal of that price. There are also examples where we moved below the 2 standard and then we kept pushing the Bollinger Bands lower until we reversed, headed higher, and moved significantly above where we've been trading when it first hit the Bollinger Band. So the reason I share that with you is because we refer to that at Options Moneymaker as a Bollinger Band snap, meaning if it moves outside the Bollinger Bands, it's likely to snap back inside. So what we do is we select a risk strike to construct our declining bias call spread where the risk strike is well outside the Bollinger Bands. That means that if the price continues to move higher and moves above the Bollinger Bands, that we're increasing the likelihood that it's actually going to reverse and move lower. Again, there's no guarantee that that's going to happen, but the frequency of which that occurs is so high that it is a very reliable technical signal in my point. Now the other thing is, how did we choose 2205? If we want to be outside the Bollinger Bands, why didn't we choose 2195 or 2200? Well, the other thing is we took a credit of $1.80 on this spread, and our guideline is to take $1.20 to $1.80. So if I had pulled the risk strike in closer, maybe to 2200 or 2195, I would have had a much higher credit, which would be nice initially, but I would be increasing my risk, and it would have been more than $1.80. So when I'm trading right at the top of the Bollinger Bands, and I can move substantially above the Bollinger Bands to open my risk strike and get $1.80 of credit, then that's a great trade in my opinion. Now I could have gone out further and taken an even lower credit, but just placing it at 2205 based on where the Bollinger Bands are was a great placement for this spread. Now the credit spread can also be used, as I mentioned, as a non-directional strategy. An iron condor is what is called the non-directional variation of a credit spread, because an iron condor basically follows exactly the same credit spread rules in cycling markets, but instead of opening a directional bias trade like we opened our call credit spread, you open both a call credit spread and a put credit spread at the same time. Call credit spread implies that there's a declining bias, and the put credit spread implies that there's a rising bias. Now we use the Bollinger Bands as a guide to choose our strikes, just like we did in our credit spread example. One side of your iron condor is always going to win on the move, and the other side is going to benefit from being placed outside the Bollinger Bands and that forgiveness factor that we built into the trade. So if you're uncertain about the directional bias when you're looking at the chart, a very simple chart with just Bollinger Bands, then your best bet is to open an iron condor and then take advantage of the cycle movements of the stock or index to close one side for a profit, wait for the reverse cycle, and close the other side for a profit. Now, I want to talk with you about what's called the seed iron condor profit strategy. This is a unique approach to trading traditional iron condors, and it's unique to Options Moneymaker. We teach this every day. We provide a lot of guidance to our clients on this every day, and I'm going to just say here that of all the strategies that we've taught at Options Moneymaker, this strategy is the most consistently profitable strategy and one of the easiest strategies for our traders community to use. We like it. Everyone on my trading team uses it. I personally use it in each of the accounts that I trade in and have some of my best series of trades from this strategy. Now, a seed iron condor is constructed exactly the same as a traditional iron condor. You use Bollinger Bands as a guide to choose the strikes, you sell to open a call credit spread, and you sell to open a put credit spread. But then at that point, this is where it differs. What you want to do is, and I'm going to show you an example of this in a minute. I just want you to understand the basis of it first. You are going to harvest profits. It's called a seed iron condor because you're planting the seed of a position out there that your intention is to harvest profits from. You're going to harvest profits from one call leg and or one put leg when the index or the stock that you're trading moves. You're essentially going to start with a 5-point spread, 5-point difference between the short and the long strikes on both your call and put spread, and then you're going to widen the spread. So you go into a seed iron condor knowing that your initial amount of capital is relatively low, minimal, but when you harvest profits, you already know you're willing to put a bit more capital into the trade. You're going to widen the spread, you're going to take a nice profit on that, and then you're going to be left with a 10-point spread either on one side, either the calls or the puts, or on both sides if you harvested profits on both sides. And then you hold the iron condor, the 10-point spread iron condor, either for an additional profit or to close out so that you keep the profits that you just took on that iron condor. Now the reason we do this as opposed to just holding the iron condor to expiration is you're going to accelerate your profits, you're going to accelerate the close of the position, you're going to recover your capital more quickly, and then you're going to recycle that capital into a new position. So the seed iron condor profit strategy, SICP, allows you to adjust to daily directional movements. If you opened the position today and you see that the market's kind of heading lower, but you open an SICP, but you wake up tomorrow and you want to harvest profits and it looks like the market is headed higher, you can choose at that point in time whether you want to harvest profits from one side or both sides. You can align your harvesting of profits with the directional movement of the index that you're trading. This offers profits as soon as the following day. Now, if you're not, I'm assuming you're not a day trader. We don't do any day trading in our kind of getting started program. In our full-time live trading room, we do some day trading, but just assume you're not doing any day trading. You wait until the following day. You're going to be able to harvest profits as soon as the following day. And you can then adjust between non-directional and directional bias. So if you opened a seed iron condor and the next day you wake up and there's a strong Bollinger Band snap on the upper Bollinger Band, you know that that's a declining bias indication. You would most likely want to harvest profits from your call spread. You would then close the put spread, and what you've done is converted from a non-directional bias trade to a directionally biased that is aligned with what you're seeing on the chart. This strategy, SICP, is also used to manage a spread that may end up in the money or problem position, and it's much more responsive to the cycles of the indexes. And generally, our experience with the SICP has been that it generates about a 20 to 25% return on capital at risk once the whole position is closed out. So now you kind of understand the concept, but let me give you a specific example. This is a real trade that we did in one of our accounts. On October 14th, SPX was trading at 21.35. We opened an SICP position and we used the 21.10 put strike as our risk strike and 21.80 call as our call risk strike. So we have a 5-point spread on the puts, we have a 5-point spread on the calls. Here are the debits and credits on each leg. We ended up with a $3.10 credit, $3.10 credit, $1.44 on the puts, $1.66 on the calls. So both of those fit nicely into our $1.20 to $1.80 guideline. We went out about 3 weeks to expiration, so it fits into our 2 to 4 week window, and we opened 5 contracts. Now 5 contracts in terms of risk is 5-point spread risk, 5-point spread risk minus the $3.10 of credit is $1.90 of net risk, and on 5 contracts, which is 500 shares, that's $950 of risk. Now that $950 of risk was right in line with what we were comfortable with for our account. If that's not something that's comfortable for you, you would be trading fewer contracts. You can trade the same position, but you might choose to only trade 2 contracts or 3 contracts. It all boils down to your appetite for risk. So that was on the 14th that we opened the position, and then on the 17th, which was the following Monday, I believe, index was trading at 2130. Now on the chart we saw a declining bias forming, so what we decided to do was to harvest profits from the short call. The index had moved down, and so what we wanted to do was to take profits on the short call, and we wanted to close the put spread. So what we did, first of all, was close the put spread for a 16-cent loss. Not a big deal at all. We just closed the put spread. See, at the time that we opened the SICP, we weren't sure which direction the index was going to move and what would be presented to us the following day. So we took a 16-cent loss on that put spread, and then what we did was we bought to close the 2180 call, and simultaneously sold to open the 2175 call. And in doing so, we ended up taking $1.81 of profit on that 2180 call. So it was $10.58 credit originally to open it, and we bought to close at $8.77. So we have $1.81 of profit. We sold to open the new 2175 call for $10.37 of credit. So right now we have a total profit of $1.65 on this trade. So now we hold a 2175, 2185, so we have a 10-point spread, and we have a credit of $1.45 on this spread, $1.45. That's $10.37 a credit. That's what we saw happening based on the charts. We already have now a profit of 16.5%, which is our $1.65 based on the gross spread risk of 10 points. It's actually a higher percentage than that, but we like to be conservative in our statement of percentage returns because we're not taking into account the $1.45 of credit. We're just looking at our gross risk on the 10-point spread, and the $1.65 on 10 points is 16.5%. So now that we've adjusted into this 10-point spread, now that we have $1.65 of profit, we can be flexible and make whatever decision we want to based on what we see going on with the cycles and movements of the index. We can wait for an opportunity for the index to move lower and then just close the call spread. And if I closed the call spread simply at $1.45, then what I'm doing is I'm closing the position, taking all of my capital back, and locking in a guaranteed return of the 16.5%, which is $1.65. Or I could open a new put spread and create another iron condor against my call spread. So I've got some flexibility as to what choices I can make here. Now on November 1st, SPX was trading at 2130. It was closed and we closed the 10-point call spread. So we closed the spread for $1.30, which was a 15-cent profit. When we're closing the 10-point spread after harvesting a profit, we're not really looking for an additional profit or any kind of significant additional profit. Objective number one in trading the SICP is to harvest your profit, widen the spread. Objective number two is to take back your risk capital as quickly as possible, because what I'm doing here is I'm taking a small additional profit, but I'm taking back 10 points of spread risk, and now I can recycle that same capital into a new 5-point spread risk trade and then harvest a profit from that more quickly than I could if I just waited for this 10-point spread position to give me more profit. In this case, we took 15 cents of profit. We took $1.65 originally, so now our total profit is $1.80, and we are back to cash. 13 trading days, 18 calendar days. This one took a little longer than most of our trades, but some of them do. But 13 trading days, not bad. $900 of profit. That's $1.80 on 5 contracts, and that's 21% on maximum risk. 21% is the $1.80 divided by the 10-point spread that we had out there minus the $1.45 of credit. So generally we find that on our actual risk that the return on these SICP trades is going to be somewhere between 20 and 25%. And even though this trade took a little longer than most of our trades and longer than we would have liked it to, still 21% return for this kind of very, very simple trading in basically half of the month is pretty good trading in my opinion. Now, I just want to mention a word about managing positions, because sometimes even with a forgiveness factor, even when you go outside the Bollinger Bands, even when you have that forgiveness factor and you have time built into your trade, a position may require an adjustment. And the really cool thing about the Seed Iron Condor strategy is it can be used as an excellent management technique. So what we're doing here, folks, is we're trying to simplify our trading. And we're starting with a root strategy called a credit spread. Everything revolves around a credit spread. The credit spread can be used as a directional strategy. The credit spread can be used to build a non-directional strategy. The credit spread can be used to build a Seed Iron Condor, which allows you to leverage very rapid profits off of the cycle movements of the index. And the credit spread now can be used to build a management strategy. So if you get very, very confident with credit spreads, you've got a simple foundation of a strategy that can give you a lot of flexibility in all market conditions. So when we end up with a position that's in the money, remember we don't want our credit spreads to be in the money, or we're approaching expiration. Remember, time is our friend. We'd like to have time on our side. So when you're in the money or approaching expiration, we may need to take some action to avoid being in a situation where we may have a loss on that trade. Losses are a reality, but we can manage in a way that will minimize the number of losses we have or the impact of the loss. Losses are a reality of trading. If you look at your trading as a business, your profits are your revenue, and losses and expenses such as education programs or we would harvest profits from that new SICP position, and we would use the new profits to close out of what has become a liability position. So I'm going to show you an example here. What this technique does is it performs a natural rollout or reposition. So you're holding a position that is now in the money. You would prefer to be out of the money, but you can't get out of the money without incurring a loss on the position that you currently hold, which then starts to interfere with your performance of your account. And by using an SICP as a management technique, you're actually able to adjust to changes in the market trend very easily by doing a natural rollout to adjust the amount of time you have in the position, and or a reposition, a natural reposition, by adjusting strikes when you have a major drawdown in your current position. So here's an example. SPX is trading at 2161. And we're holding a January week 1, 2145, 2155 call credit as the mark, which is the midpoint between the bid and the ask. So that's a pretty healthy drawdown on that position. And if we take no action, we could likely just incur that amount or more as a loss. And there's no reason for that to occur. So our options, the way we see it, are to hold and take no action because we have time to expiration. We still have some time to expiration. Or we can open a new SICP position using January week 1 expiration or a further out expiration so that we can execute a natural reposition and rollout. It's basically going through a process to adjust the position we have, adjust the credit that we have, adjust the time that we have in the position so that it is back to being a position that is likely going to grab a profit for us. So we're holding that 2145, 2155. What we decided to do is open a new SICP. We didn't feel comfortable just sitting by and waiting. Even though we could look at the chart, we have still some time left in the position. But we decided to go ahead and take action. We opened a 2235, 2230 January week 2, so we went out 1 week further than the position that is a liability. We opened the 2235, 2230 put spread, and we sold to open the 2300, 2305 call spread. Now remember, we're holding a 2145, 2155 call spread. So we've now reset our risk strikes to 2300 on the call side and 2235 on the put side. When the index moves, we're going to harvest profits from 1 or 2 legs of our new SICP by widening the spread from 5 points to 10 points. We're going to then use those profits that we gain, and we're going to close the 2145, 2155. So what the new SICP does for us is it gives us profits that we can harvest that will allow us to close out of the problem position. We have a loss on the problem position, but we harvested profits from the new position that pays for that. It pays off the debt. And what we hold then is a new position that once it's closed, once we are able to close this position at a break-even on the new credit, then basically we may end up with no profit and no loss on the entire transaction, but we didn't lose our capital. We protected our capital, we protected ourselves against a major drawdown, a major loss on the position, and we're now back to finding good productive positions. So what this move does is it naturally moves the risk strike from 2145 to 2300, and it added 1 additional week to expiration. Now we're in protection mode here. The SICP is being used to protect us against a major loss. Most options traders do not know how to protect themselves against a major loss. Most option traders just use stop losses. That's the extent of their knowledge, but they don't really understand how to use the flexibility of options and the flexibility of a strategy like SICP to be able to harvest profits and pay down other problems and then retire that new position eventually so that you have all of your capital back with no harm to your account. So here's a snapshot of the chart. Here's the 2300 risk strike. Look at this, well outside the Bollinger Bands. So positioning it outside the Bollinger Band sets us up to win with no guarantee that we're going to win, but it's a better placement than the lower risk strike that we were dealing with. Here's the put risk strike right here, 2235. So outside the Bollinger Bands, we basically bracketed the Bollinger Bands. So you leverage the cycles based on Bollinger Bands. It's a good approach for newer traders. It keeps things really simple when you're just starting out especially. You build a forgiveness factor into each trade. It actually helps you be wrong, perhaps on the directional bias of the trade, but still potentially be profitable on that trade. But the SICP, the Seed Iron Condor profit strategy, allows you to generate profits on a regular basis or manage a challenged position. That single strategy is just based on a simple credit spread. So when we talk about simplifying your trading, this is really how easy it can be. Now, I know I've given you a lot of information today, but I'm happy to take questions here in just a minute. But our whole focus is on, at Options Moneymaker, is on trying to simplify things as much as possible so that anybody can successfully trade options. I can't guarantee that everybody will successfully trade options because I can't reach into you, your home, your account, and know that you're following directions and following what you learned. But we do our best to help anyone trade options successfully. We try to eliminate all the complexities when you're getting started. You can add those complexities later on once you feel confident and you've grown your account a little bit. Recycling capital is a significant part of growing your account. Recycling your capital and even compounding it to a certain degree is the way you're actually going to grow an exponential return on your account. It's not because you're putting big risk out there. It's because you're taking a lot of profits over and over and over again, allowing you to generate more and more profits off of the same capital. So let me just kind of give you an idea of how that has worked for us. In one of our programs at Options Moneymaker, it's called our Profit Builder program. It's where we suggest that people who are brand new to options trading and have an interest in learning is where they start. It's also where we suggest people who may have just gotten all out of whack with their options trading but still have an interest in really learning, maybe relaunch their own trading business with the Profit Builder program. But in 2015, we started with a live account value of $11,000. Now, there was no magic about it being $11,000. It happened to be an account that belonged to me. This is a live account. This is not a hypothetical account. This is not paper trading. I had an account that I wasn't doing any trading in at the time, and it had $11,000 in it, and it was a reasonably small amount of money. And what I decided is we were going to demonstrate to people every single day how to trade successfully. And so we trade this account in front of an audience every day, in front of all of our trading community. And what I decided is that although I had $11,000 in the account, I was willing to risk up to $5,000 initially. And then as the account grew, I might grow my risk. But I didn't want to have more than $5,000 of risk on at the same time. So I assumed that was going to be somewhere between maybe two to four positions, more like 3 to 4 positions. So $5,000 of risk. So anyway, our first year total profits off of that $5,000 initial risk was $14,317. Now we were ecstatic about that because we had a lot of clients who followed along with us, a lot of clients who benefited from that, and $14,000 is a huge amount to make off of a $5,000 initial risk commitment. By also starting with $5,000, we were trying to help people stay out of trouble. I had many people that would be interested in our program and would send me notes about, I've got a $100,000 trading account, or I have a $500,000 trading account. How much should I start with? And the answer was always the same. Start with $5,000. Because just because you have a large account doesn't mean you really know what you're doing yet. And I'm not trying to be offensive to anybody, but I really wanted people to start with something that if they lost $5,000, it wasn't going to change their lifestyle. If they made mistakes while they were learning, they could still probably stay in the game. So that was the whole premise of starting with $5,000. And then in 2016, we just closed 2016 with $12,160 profit, a little bit less than 2015, although I will tell you that volatility completely evaporated out of the market, created a few more challenges, but those were challenges that just meant we made a little bit less in 2016. It didn't mean that we lost. We had losing days, we had losing positions, but overall we still had a great year. And this is all accomplished with credit spreads and SICP trades. It's the constant flow of working the SICP trades and the credit spreads based on Bollinger Band patterns and the signals that we see on the chart, and then just doing what's necessary every single day. So we try to keep it as simple as possible, but we consider it a very powerful way to start small and grow a big account. So I'm just going to share this overview with you, and then I'll take questions here. The Profit Builder program is designed for new and casual traders, but it's also great for experienced traders who may need to relearn, maybe come back to the beginning and start over a little bit. So this is a program that includes, I'll just kind of highlight these real quickly here. You get a lot of content, a lot of upfront education content out of this. 4 hours of on-demand videos. You can watch them at your leisure, all on options, basics, and credit spreads. So if you're brand new, that's really where you want to start. You also get 6 hours of on-demand videos on how to earn roughly 20% or more on your risk, not on your total account size, but on the risk that you have in each position, trading the SICP strategy. So that's about 6 hours. And then we have 3 2-hour Q&A sessions that when we first launched the SICP, our trading community joined us for Q&A sessions, and you get to listen in on those as part of your education. And then we also give you a PDF that you can download and print. It's the Trader's Guide to Option Basics. We also give you a Trader's Guide to Credit Spreads, and this also includes a 1-month access to our Profit Builder live trading rooms, which is the first hour and last hour of each market day. Now, in that trading room, the first and last hour of each market day, we're placing trades. We primarily are working SICP trades. So if you have the time to listen in, and the first session is not always an hour. It's long enough for us to harvest profits and answer a few questions. But if you have time to listen in the morning, and you can look over our shoulder and watch how we harvest profits from these positions and manage them, that, to me, is one of the most effective ways for you to learn what you're doing. And then the end of the day session is how we choose the SICP positions, and also during the end of day session we record that and send it out. So if you can't attend the live sessions, you get a recording of them for an ongoing education. And then we also send out trade alerts. We send an email and text each time we open, close, or harvest a profit from a position. So the value is, I think, way more than what we've even priced it. All of this combined is priced at $920. But we are making it available for a limited time for just $395. You get all of this for $395. You get the 1 month access to the live trading rooms, you get 1 month of the reviews, you get 1 month of the trade alerts, and you get all of the video content. So it's a great way to get started and really learn if you're committed to your trading business and want to get it on the right track. So if you're an experienced options trader or a new options trader, you can sign up for just $395 today. That's about a $525 savings over the regular price. That price is not going to stay there for long, but we are making it available to a few of our preferred partners, clients of our preferred partners. So if you're interested, the link is optionsmoneymaker.com/what we offer. And I'm going to take questions now until they kick me out. And if I don't get to your question today, or if you think of a question later, we're very committed to trying to help you understand what we're doing and decide whether or not what we are doing is right for you. We're not right for everybody, so this is kind of a self-selection process. You're not going to get a bunch of phone calls from us trying to get you to sign up. We'd like you to choose us if it's right, but you can send me an email to mark@optionsmoneymaker.com if you have an additional question after today. All right, let me see if there are any questions here. Joe's asking, how much does the monthly cost to continue after that? Joe, after the first 30 days at $395, it's $129.95 a month. Now, our pricing is not just arbitrary. What we've done is we have priced at a point where we are very confident that on an ongoing basis, you can trade one position, harvest profits. If you're following along with us, you can harvest profits from a single position, even just a 2 or 3 contract trade, and pay for your monthly subscription. Comfy's asking, what guarantee do you have for this payment? We don't guarantee that you're going to be successful, Comfy. What we do is we guarantee and commit that we will do everything we possibly can to provide you access to the information you need to be successful. And we put ourselves on the spot where you get to see our account every single day. It's a live account. You're going to get to see live positions placed. You're going to see when we take a loss. You're going to see when we have a profit. But the reason we don't provide a overall guarantee of this is I can't guarantee that you're actually going to follow what we do, that you're going to actually follow along with the methods that we teach. Alex asking, can we just sign up for the monthly service? No. You have to have some basic understanding of what you're doing, or you're going to be lost if you just join the monthly service. The monthly service is $129.95 a month, so it's really just the $395 is upfront to give you the knowledge and the content you need in order to be able to follow along successfully. We're not interested in just collecting fees from clients. We're interested in providing a service where you're going to go make money. So, like I said, our service and our education programs are not right for everybody. If you're just concerned about the extra couple $100 up front, it might not be the right service for you, but that's something you need to consider. Joe, shoot me an email about that. I think the answer to your question is yes, because we've changed a lot of the content, but we might be able to do something for you there. But shoot me an email about that. Gilbert, how much do we need to get started? My suggestion is that you have an account size where you are comfortable putting at risk up to $5,000. But that generally means that you should have an account size greater than $5,000. So in an ideal world, I would say you should have an account size of 8 to 10,000 with a willingness to risk up to 5,000. Now, you can change that if you want to. If you're not comfortable risking 5,000, you may start off just trading one position at a time, and you might not have any more than $2,000 of risk at a time. Your profits are going to be slower, which is fine, but your risk is going to be smaller too. Alex, I understand some of you are fast learners, and I appreciate you saying that, but we are very selective about where we invest our time. And if you don't understand the basics up front, there are a lot of questions you're going to ask, and that will actually distract us in trying to respond to those questions, as opposed to assuming that everybody has kind of the prerequisite knowledge and understanding that comes from these trades. And again, frankly, if you're concerned about the difference between the $129.95 for a month versus the $395, it's probably not the right program for you. The $395 upfront for 30 days can easily be recovered in 1 to 3 trades, even in a learning curve. So it's just not an expensive program, and it's super discount right now, and it's not going to stay that way forever. Gene wants to know how much money in the account to trade such that you break even every month with the monthly fees. Again, $5,000 of risk will get you there. On a single trade, on a single 2-contract trade, it is reasonable that we should be able to harvest somewhere between $200 to $250 of profit. And so the monthly fee is $129.95. So that's just on a single trade. And we're generally doing 2 to 3 trades a week. So you can do the math on that. But we've really tried to price this in a way that makes it palatable for most anybody who wants to trade and is really committed to learning. Walter's asking what's the win-loss ratio on this program. We don't track our win-loss ratio. It's really not relevant to us. It's one of the other simplifications that we preach. Win-loss in terms of trade by trade isn't going to tell you anything. The amount of profits that you have at the end of a year is really going to be the answer to whether or not this has worked for you. So when I look at the profits that we accumulated in the first year and the profits that we accumulated in 2016, that takes into account all winning trades and all losing trades, and it doesn't really matter to me how many trades that equated to. Those numbers that I provided to you also are net after fees and commissions. So I'm not giving you a gross number that then you have to whittle down for fees and commissions. Those are net numbers. Those are net profit numbers. So again, we've simplified our program down to a point where we will focus on only the things that matter. We don't track a whole bunch of stuff that really won't help you make money. And in the type of program like this, tracking win-loss ratio is really not a relevant measurement. Maybe you missed that, Walter. What were the profits you accumulated? Let me back up to that slide. I showed that. Let's just see here. Oops. Let me just give me a second here. Got a little user error going on here. Here you go, Walter. First year total profits $14,317. Showed the slide. 2016 profits $12,160. So nice healthy profits for starting with $5,000 of risk. Let's see here. Where can I see a spreadsheet of your trades in the last year? Yeah, we actually, as part of this program, provide a spreadsheet shell, a template, to our clients so that you can keep track of your trades. And then if you want to keep track of our trades, you can do the same thing because you'll see our trades every single day. You'll see whatever action we take on our trades, and you can track those. But all we really track is end of week performance, end of month performance, end of quarter performance, and of course full year, which I just shared with you. Gene's asking, how much is your risk per trade? So if you're just starting out with $5,000 of risk, you're probably not going to want to have more than an initial few $100s of risk, Gene. If we're doing an SICP trade, let's say we open 2 contracts. I'm just going to kind of use some general numbers here. you might have initial risk of $400. And then when you widen, excuse me, when you widen the spread, you may end up with total risk of somewhere around $1,000. So that's about $1,000 of risk committed to the trade. So if you're comfortable having $5,000 of risk, I wouldn't still have 5 positions open. I might have 2 positions open at a time, so that you're giving yourself a really nice cushion between your maximum risk that you're willing to allow in the market and where you're currently at in terms of your risk.